A 67-year-old retired teacher in Georgia wrote a check for her property tax bill in November of last year, the same way she had done every single year for the past 31 years. Same amount, same county office, same process. What she did not know, what nobody had ever told her, not her bank, not her accountant, not the county clerk's office that cashed her check, was that she had qualified for a property tax exemption specifically for seniors over 65 years old that would have reduced that bill by more than half. She had been eligible for 3 years. She had overpaid 3 times. And the county clerk's office, the same office that processed her payment every single November, had never once mentioned that the exemption existed or that she qualified for it. When she finally found out, from a neighbor who happened to mention it at a church gathering, she called the county office directly. They confirmed the exemption. They confirmed she had been eligible. And they told her that because she had never applied, there was nothing they could do about the previous 3 years of overpayment. The money was gone. That is not an isolated situation. It is happening to seniors in every single county in this country right now. Not because the exemptions do not exist, because they do, and in most cases they have existed for decades, but because the agencies and institutions that know about them have absolutely no financial incentive to tell you. The IRS does not send letters explaining which tax benefits seniors are newly eligible for after 65. Banks do not call customers to explain which fees disappear after a certain age. And county clerk offices do not follow up with property owners to ask whether they have applied for the senior exemptions that would reduce their tax bill. The information exists. The savings are real. And the only thing standing between you and those savings is knowing that these programs exist and understanding exactly how to claim them. That is what we are covering today. My name is Mason Parker. I track the financial rules, exemptions, and policy details that affect seniors specifically, the ones that government agencies are required to offer but are not required to advertise. What I am covering today involves 3 separate institutions: the IRS, your bank, and your county clerk's office, and 3 separate categories of bills that a significant number of seniors over 65 are still paying when they no longer have to. Before we get into all 3, subscribe right now and turn on the notification bell. Next week, I am covering a 4th exemption that applies specifically to seniors over 72, one that most financial advisors never mention because it does not benefit them to bring it up. Subscribe now so that video reaches you when it posts. Let us start with what is happening at the IRS level, because this is the category where the largest dollar amounts are concentrated, and it is the one where the gap between what seniors are paying and what they actually owe is most consistently significant. There are 4 specific IRS provisions that apply to seniors over 65 that reduce what you owe the federal government in ways that most seniors are either not claiming or not claiming correctly. The first is the enhanced standard deduction. Every taxpayer over the age of 65 is entitled to an additional standard deduction on top of the regular standard deduction that applies to all filers. For 2026, the additional amount is $1,600 for a single filer and $3,200 for a married couple filing jointly where both spouses are 65 or older. This deduction is not automatic. It does not appear on your tax return unless your tax software or your tax preparer specifically selects the checkbox that indicates you are 65 or older. If you have been filing your own taxes using software and have not confirmed that your age has been accurately entered and that the enhanced deduction is being applied, it is worth pulling up your most recent return and verifying that this deduction appears on your Schedule A or in your standard deduction calculation. If it does not, you may have been overpaying your federal taxes for multiple years, and an amended return using Form 1040X is available to recover up to 3 years of that overpayment. The second IRS provision involves Social Security taxation thresholds, specifically the income level above which your Social Security benefits become subject to federal income tax. Up to 85% of Social Security benefits can be included in your taxable income if your combined income exceeds a specific threshold. But the calculation of what counts as combined income for this purpose is more nuanced than most people realize, and many seniors are including income sources in that calculation that should be excluded, or are failing to claim deductions that would bring their combined income below the threshold where Social Security taxation kicks in. If your Social Security benefits are currently being taxed, it is worth having a tax professional specifically review whether your combined income calculation is being done correctly, because even a relatively small adjustment to that calculation can move you below the taxation threshold entirely and eliminate the Social Security tax from your return completely. The third IRS provision involves medical expense deductions, specifically the threshold that applies to seniors. Taxpayers under 65 can only deduct medical expenses that exceed 7.5% of their adjusted gross income. For taxpayers 65 and older, that threshold is reduced, making it easier to qualify for the deduction. In retirement, when out-of-pocket medical costs, prescription expenses, hearing aids, dental work, vision care, and long-term care premiums are often significantly higher than during working years, this lower threshold can make the medical expense deduction available to seniors who would not have qualified for it during their working years. The fourth provision is the credit for the elderly or the disabled, a specific tax credit, not a deduction, that is available to seniors over 65 who meet certain income requirements. A tax credit reduces your tax bill dollar for dollar, which makes it more valuable than a deduction of the same amount. This credit is consistently one of the least claimed credits on the entire federal tax return, primarily because its existence is simply not well known. If your adjusted gross income falls below approximately $17,500 as a single filer or approximately $25,000 as a married couple filing jointly, you may qualify for this credit and have never claimed it. The form is Schedule R, available at irs.gov, and it can be filed alongside your standard federal return at no additional cost. The second institution hiding bills you no longer owe after 65 is your bank. And this category is different from the IRS exemptions in one important way. Bank fee waivers for seniors are not federally mandated programs. They are policies that individual banks choose to offer, and the banks that offer them almost universally do not advertise them to existing customers. The result is that millions of seniors are paying monthly maintenance fees, minimum balance fees, paper statement fees, and ATM fees every single month on accounts where those fees would be waived entirely if they had simply asked about senior account options. Here's what the fee landscape actually looks like at the largest national banks operating in 2026. Most major banks offer at least one checking account specifically designed for seniors over 62 or over 65 that carries no monthly maintenance fee regardless of balance. Many of those same accounts waive the minimum daily balance requirement that would trigger a fee on a standard checking account. Paper statement fees, which can run between $1 and $3 per month on standard accounts, are waived on most senior account tiers. ATM fee reimbursements, where the bank refunds the fees charged by other banks' ATMs, are available on some senior account packages at no additional cost. Overdraft fee structures are modified on certain senior accounts to include a grace period or a reduced fee that does not apply to standard accounts. None of these waivers happen automatically when you turn 65. None of them are applied to your existing account without a specific request. The bank is not going to call you on your 65th birthday and move you to a fee-free senior account. The process requires a single phone call or a single in-branch conversation where you specifically ask whether your current account type is the most appropriate option for a customer your age, and whether a senior account tier is available that would reduce or eliminate the fees you are currently paying. That conversation takes approximately 10 minutes. For seniors paying a monthly maintenance fee of $15, a minimum balance fee of $12, and a paper statement fee of $2 per month, that 10-minute conversation represents potential savings of over $340 per year, every year, for as long as you hold the account. Before we get into the third institution, the county clerk's office, and the property tax exemptions that are the most consistently overlooked savings available to seniors anywhere in the financial system, subscribe right now if you have not already. Every week on this channel, we go through the specific programs, forms, and policy details that reduce what seniors owe to institutions that have every reason not to bring these options up on their own. The people who find this channel and watch regularly are the ones walking into these conversations informed, asking the right questions, and keeping the money that was always theirs to keep. Subscribe now and turn on the notification bell. The third institution hiding bills you no longer owe after 65 is your county clerk's office. And this is the category that produced the story of the retired teacher in Georgia at the beginning of this video, because it is the one where the gap between what seniors are paying and what they actually owe is most consistently dramatic in dollar terms. Property tax exemptions for seniors exist in every single state in the country. The specific structure varies significantly from state to state and even from county to county within the same state, but the underlying principle is consistent. Most jurisdictions offer at least one form of property tax relief specifically for homeowners over a certain age, and in most cases that age threshold is 65. The forms these exemptions take vary widely. Some jurisdictions offer a flat dollar reduction in the assessed value of your home for tax purposes. Others offer a percentage reduction in your total property tax bill. Some offer a tax freeze that locks your property tax bill at the level it was when you first qualified, so your taxes cannot increase even if your home's assessed value rises. And some jurisdictions offer a full exemption on a portion of your home's value that removes it from the taxable assessment entirely. In many jurisdictions, multiple exemptions can be stacked, meaning you can qualify for and claim more than one at the same time, reducing your bill further than any single exemption would on its own. The reason most seniors are not claiming these exemptions is not that they are difficult to obtain. In most counties, the application is a single 1 or 2 page form available directly from the county assessor's office or county clerk's office, either in person or downloadable from the county's official website. The reason most seniors are not claiming them is that nobody tells them the exemptions exist. The county mails your property tax bill every year. It does not include a note explaining that a senior exemption application is available that would reduce the amount on that bill. The county assessor's office processes your payment when it arrives. It does not follow up to ask whether you have applied for the exemption you qualify for. The process is entirely opt-in, entirely dependent on the property owner knowing the option exists and taking the specific step of applying for it. And in counties where the exemption has been in place for decades, a significant number of eligible seniors have simply never heard of it. Here is exactly how to find out what you qualify for and how to claim it before your next property tax bill arrives. Step 1. Call your county assessor's office or county clerk's office directly. The number is typically available on your most recent property tax bill or on your county's official government website. When you call, ask specifically whether any senior property tax exemptions, senior homestead exemptions, or senior assessment freezes are available in your county, and what the age and residency requirements are to qualify. Step 2. Ask the representative to mail you or email you the application form for every exemption you qualify for. Do not rely on finding these forms independently. Ask the office to send you exactly what you need so you are certain you are applying for the correct programs. Step 3. Complete each application form and return it to the county office before the application deadline. Most counties have a specific deadline each year by which senior exemption applications must be received to take effect on the following year's tax bill. Missing that deadline by even 1 day typically means waiting another full year before the exemption takes effect. Ask the representative explicitly what the deadline is for the current year when you call. Step 4. Once your application is approved, confirm that the exemption has been applied to your account by reviewing your next property tax bill when it arrives and verifying that the assessed value or the total amount due reflects the reduction you applied for. If it does not, contact the assessor's office immediately rather than simply paying the higher amount and assuming the exemption will be applied the following year. Here is the complete action list for everything covered today. At the IRS level, confirm that your federal tax return is claiming the enhanced standard deduction for taxpayers over 65. The additional amount for 2026 is $1,600 for single filers and $3,200 for married couples filing jointly where both spouses qualify. Review whether your Social Security benefit taxation calculation is being done correctly, particularly if your income is close to the threshold where benefits become taxable. Check whether your medical expenses in retirement are high enough to qualify for the medical expense deduction under the lower threshold that applies to seniors. And look up Schedule R at irs.gov to determine whether you qualify for the credit for the elderly or the disabled, which reduces your tax bill dollar for dollar and is one of the least claimed credits in the entire federal tax system. At your bank, call your bank's customer service line or visit your local branch and ask specifically whether a senior account tier is available that would reduce or eliminate the monthly fees you are currently paying. Ask about maintenance fees, minimum balance requirements, paper statement fees, ATM fee reimbursements, and overdraft fee structures. The conversation takes 10 minutes and the savings can exceed $300 per year. At your county clerk's or assessor's office, call directly and ask what senior property tax exemptions, homestead exemptions, and assessment freeze programs are available in your county. Ask them to send you every application form you qualify for, and ask for the exact deadline by which applications must be received to take effect on your next property tax bill. None of these conversations are complicated, none of the forms are expensive or difficult to complete, and the combined financial impact of claiming everything you are legally entitled to at the IRS level, the bank level, and the county level can represent thousands of dollars per year that has been leaving your account unnecessarily. Subscribe to Mason Parker USA and turn on the notification bell. Share this video right now with one senior you know who owns their home and has never applied for a property tax exemption. One conversation started by this video could save them more money every single year for the rest of their life than they would expect. I will see you in the next one.